G'day guys, welcome to the channel. My name's Tim, and on today's episode we're going to take a look again at this 4-year cycle, and I've got another way to show this potential correlation that we're seeing with the macro markets. Now, in today's video, we're going to be looking at the S&P 500, which is this line down here, this blue line, and you can see it bouncing off the 30-month moving average. And we're also going to take a look at Bitcoin. And what I've done is I've measured in these major correction points, and I'm going to pose an alternative view to the lengthening cycles theory and show that the cycles aren't necessarily lengthening. Now, this is a theory as well, but I'm going to show you the evidence to try to back up this theory that the cycles are not lengthening. They're not necessarily shortening, they're just random. And I'm going to show you the difference between the lengthening cycles and when we're measuring from the bottom, measuring from the halving, and then also measuring from these macro market correction dates. Now, I'm not hearing many people, in fact, I haven't heard anyone talk about these macro market correction dates. I don't believe there's anyone on Twitter that's really talking about these particular dates. So I'm out on my own, but I have noticed a narrative that it's almost like it's agreed that the cycles are lengthening, and I think that there's a problem with that because it's almost groupthink. It's almost like, yep, that is the case. Yep, they're definitely lengthening, and that's that. But I'm going to show you an alternative view just to try to give a different perspective. So anyway, let's get stuck in. So we're looking at Bitcoin here, right back to 2011, and I'll just shrink it all up so we can see how it's looking. Now, what I've done is I've marked these vertical lines when the S&P 500 has come back to the 30-month moving average, the simple moving average. And you can see here, if I just make it a little bit more expanded, you can see that it very clearly bounces off the 30-month, starts off a little bit rocky, and then comes back down to it, okay? Starts off a little bit rocky, comes back down to it, starts off a bit rocky. Now, in this case, this is the March 2020 crash. You'll notice here that it was right in the middle of the cycle, right in the middle of after this bounce off the 30-month. And you can see in other cases, we have come back down to it right there. There's been these little dips near the start, so it's not unheard of to come back and have a bit of a dip. But this was a very severe dip. But as you'll notice, we just got on our bike and it almost made no difference. It's almost like the cycle didn't even care. So that was a V-shaped recovery, and that's why I don't really count that as an official bounce, even though there's nothing official here, but I don't really count that as a bounce off the 30-month. In fact, it even went a bit lower. But these are the dates that I really think are the important ones, and that's where I'm measuring the Bitcoin cycles from. So if you look here, you could be forgiven for measuring the Bitcoin cycles from the bottom. If you're living in the Bitcoin bubble and not really looking at the other macro markets in relation to it, you would probably measure the bottom of Bitcoin. So if we look here at the 2017 peak, right down here, this is where you'd probably measure the start from. So you go, okay, if that's the bottom, then it took a certain amount of time to get there, okay? Now, if you measure from the halving, the actual halving dates are in the 2017 cycle, we have a halving date of July, so 9th of July in 2016. So if we go to July 2016, 2016 is about there. So the halving date was about there. And you could say, well, okay, that's when the halving was, and that's when the market went up. Okay, and there's no doubt that the halving is a bullish thing to happen. You can't argue that the halving can be bearish in any way, but you just wonder whether that is the trigger for what triggers the market to go to these mania levels, or whether the fact that we're right here in the middle of a macro market cycle, which we've seen in 3 occasions, right here in the middle of when the S&P 500, as an example, is right up and about, perhaps that is what's causing the Bitcoin price to go into a mania phase. Perhaps that is the risk-on phase of the macro markets. And the halving doesn't hurt, but maybe the halving isn't the sole reason. And we've got to be careful with these assumptions. There's an old saying, the assumptions are what gets you. And, I don't know either. Maybe this is irrelevant. Maybe this macro market cadence is irrelevant too, but I'm just putting it out there. All right, so let's have a look. So we've got these dates. You can see right here very clearly. These are the dates when the macro markets have corrected, and we haven't corrected yet. So you can see we are about a similar level without even measuring, and this is in a log format. We are at a similar level that we've been at in the past, okay? But you'll notice that looking at this on a monthly timescale, we don't have a crash, like a vertical crash that just comes straight down to the 30-month moving average. It's more of a gradual, almost a sideways movement, and then at the very last couple of months, we just come back down. So that's all pretty much goes sideways. And in 2017, we had a peak, and then over 2018, it dipped, came back up to that same level again, and then in the last couple of months of 2018, it just went down. So, this time may not be different. Maybe we go along sideways like this, and then the last couple of months, we go down. Okay, so that is something to look out for in 2022. The markets at least look like they could be doing that again. It's hard to imagine the market's doing that all of a sudden, especially when you look at China going down and the US being very closely correlated with China. Okay, now what I've done here, let's have a look at the dates. So right here, September 2011. Now, if you look at the peak of Bitcoin back on the 2013 cycle, right here in November 2013, if you measure from the macro market correction date, and you'll see that it's not exactly the bottom. It's actually slightly before the bottom, okay? Now, if you measure from that date, it turns out to be about 2.16 years to the peak. And then it was about 1.8 years until we reached the next the macro market drop. And you can see that Bitcoin actually hit a bottom before that point, but it stayed down there until this point. And that point there is pretty much when it started to go up. So, I mean, we had the halving over here. We had the halving right here in July, okay? But looking at this, that's the point when the market started going up, okay? So that is at least some evidence to keep a closer eye on what these macro markets are doing, especially these correction dates. All right, now let's have a look at the 2017 cycle. So if we start from here, September 2015, again, this is all at a monthly time scale, and that's we're really focusing on the macro here, so having a monthly resolution is fine. It was actually about 2.25 years until we got to the peak, okay? Now look at this. Look how quickly we corrected in the 2017 cycle compared to what happened in 2013. 2013 was a much larger correction. Now, we did go down, but then we stayed sideways and stayed low for a couple of months. Okay, 2017 just fell out of the sky. Look at that, 2018 by that stage. And it corrected down around about, it's about half a month off, I guess. Maybe a month off. It's about a month off from the exact bottom of Bitcoin to when the macro markets corrected. Okay. And then again, almost immediately after the macro markets corrected, we started going up again, just like we did here. So there's yet some more evidence to say that we should be paying attention to these macro markets. And right at the moment, next time we correct, if we are to follow the same pattern, which we've followed in the past, that could be a really good entry point, because that may be the time that we start bouncing off and breaking this downward trend. You can see here, we didn't really start going up despite the macro markets. Bitcoin is very in sync with what the macro markets are doing. Same again here. We didn't come back down and at this point go, okay, we've leveled out, let's go up again. No, we went down with the macro markets. And you could, you can almost argue this is the dip and then we recovered from the dip. But you've got to keep an eye. Okay, so right now in the 2020, let's call it 2021 cycle, when we peaked in April and also November, I measured it from this macro market date, 2.25 years to the peak on a monthly time frame, which is exactly the same amount of time as in 2017, and 2.8 years to get to this second peak. And it can be debated after the fact whether this second peak was like a dead cat bounce that got a bit out of hand, compared to these other cycles. You can see we didn't quite make the same height there, and we didn't quite make the same height, here. This time around, we actually did make the same height twice, which is really interesting. Okay, so yeah, so the 2021 cycle looks a little bit different with the double peak, but the time it took to get to at least the first peak was pretty much identical to what happened in the 2017 cycle. Now, you notice here, the distance between here and here, between these macro market correction dates, was 4 years. And then in the 2017 cycle, if I can get rid of that, it was 3.3 years. So to me, that's not lengthening. 3.3 years is shorter than 4 years, okay? Now, so far, we're at 3 years, and we are coming down, but, we will probably bounce at some stage. We'll probably have some relief rally, but at the moment, we are still on track to be a similar length to the previous cycle when measured from the macro market correction dates. So that's the whole point of this video, is that we don't want to be locked into the assumption that all there is the halving and the Bitcoin bottom. There are other ways to measure the cycles, and those assumptions could be hurting us. They could be making us think things are different from what they are. We could be assuming that, okay, this is a much shorter cycle, so we're going to have a mania phase because we haven't had it yet. But that could be dangerous thinking. All right, now the last thing I'd like to have a look at here is where we are here in terms of the drop so far. Now you can see back in 2013 or 2014, we dropped about 80% from the peak down to these levels. Then in 2017, 2018, we dropped 75%. Now, it's possible we drop, this kind of level again, but it's also possible we don't. This is a little bit of speculation right now, but what I did is I measured the distance between the peak and this neckline, if this is a double top. If we treat that as a double top, and we dropped about 40% to this neckline, and then another 40% from there is about 65% as a drop. And that brings us to about 21K. And the reason why 21K is very interesting is because that is where if I go here to a weekly chart, that is where the 200-week moving average, and I'll just change this to 200 weeks. That is where the 200-week moving average, which we've bounced off traditionally in the past, is likely to be. At the moment, the 200-week is at about 19,500, and it's rising slowly. It's unlikely to keep rising too much more while we're coming down. So coming down to around the 21K mark, maybe we, whatever the price does, 21K is about there. So that's, again, this is speculation, but perhaps we only drop about 65% from the top. There is a bit of a trend here, 80%, 75%. We didn't go up as high this time. We've already dropped about 40 or 50%. So yeah, getting to around that 65%, which also correlates with the 200-week moving average, is a possibility. And if the S&P 500 does what it's done in the past and goes sideways for a bit and then come back down to the 30-month moving average, that is a potential scenario. So again, that's all speculation. But the main point of this video is that we have to be careful with assumptions. And if we measure from these macro market correction dates, which have shown a lot of correlation in the past, then the cycles are not necessarily lengthening. They're just at the mercy of what the macro markets are doing. And not only that, but we are currently about 3 years through this macro market when measured from the previous time we had the macro market correction, which is around December 2018. So the two markets before that, or the two cycles before that, were 4 years and 3.3, and we're coming into that final quarter, I guess, of a football game, coming to that final quarter. So yeah, we're getting into the vicinity of this 3.3 to 4 year cycle. Anyway, I hope you enjoyed that video. It was a little bit of more insight about what's happening with Bitcoin at a macro level. A lot of it's still speculation. We'll have to see if this theory plays out. The theory could prove to be wrong. But so far, there is a lot of evidence to suggest that we should be keeping an eye on this, in addition to looking at things like the halving and the Bitcoin bottom. So until next time, I'm Tim, and cheers.